How to calibrate AML transaction monitoring scenarios. Practical guide. This is a free course from Learning tabs. This course will help you to understand the regulatory framework, evaluate and identify key risk factors, review historical data and patterns, scenario development and optimization, validate with backtesting and tuning, monitor and adjust for emerging risks, use of machine learning and advanced analytics, training and stakeholder involvement, documentation and audit trail. Calibrating anti-money laundering, AML, transaction monitoring scenarios is crucial for maintaining the effectiveness of an organization's compliance framework. A well-calibrated monitoring system ensures that the institution can detect suspicious activities while minimizing false positives and false negatives. It is an ongoing, data-driven process that requires balancing sensitivity and specificity to capture illicit transactions without overwhelming the system with unnecessary alerts. Calibrating AML transaction monitoring scenarios is crucial for several reasons. Effective detection of suspicious activity. Calibration ensures that the system accurately identifies high-risk transactions and reduces false negatives, preventing money laundering activities from going undetected. Minimization of false positives. Proper calibration helps reduce the number of false alerts, allowing compliance teams to focus on genuinely suspicious transactions, improving efficiency and reducing alert fatigue. Regulatory compliance. Regulators expect institutions to adopt a risk-based approach to AML. Calibration aligns the system with regulatory expectations, helping avoid fines, penalties, and ensuring the system meets compliance standards. Tailoring to institutional risk. Each institution faces unique risks based on its customer base, geography, and product offerings. Calibration customizes monitoring scenarios to reflect these specific risks, ensuring that suspicious activities are flagged appropriately. This course will outline the key steps and best practices for calibrating AML transaction monitoring scenarios to achieve optimal performance. 1. Understand the regulatory framework. Before beginning calibration, it's essential to have a comprehensive understanding of the regulatory requirements that govern AML transaction monitoring in your jurisdiction. Global regulatory bodies such as the Financial Action Task Force, FATF, Financial Crimes Enforcement Network, FinCEN, and regional regulations like the European Union's AML directives or the UK's money laundering regulations provide guidelines that must be followed when designing and calibrating monitoring scenarios. Ensure that the calibration aligns with local AML regulations and reporting obligations, risk-based approaches outlined by regulatory bodies, the institution's AML policies and procedures. 2. Evaluate and identify key risk factors. The calibration process should start with a comprehensive assessment of the money laundering risks specific to the institution. This involves evaluating and identifying the key risk factors that are inherent to the institution's business model, customer base, geography, and product offerings. Understanding these risks is crucial to developing effective transaction monitoring scenarios that are tailored to the institution's unique profile. The critical components to focus on during this phase are: business model. Different financial institutions engage in a variety of business activities. For example, a retail bank will have different risks compared to an investment bank, a money service business, MSB, or a wealth management firm. The business model will determine the types of transactions that occur frequently, which can either mitigate or heighten the institution's exposure to money laundering. Customer profile. The risk levels associated with the institution's customer base are central to scenario calibration. For instance, politically exposed persons, PEPs, high net worth individuals, HNWIs, corporate clients, or customers from high-risk industries such as casinos or real estate are more likely to engage in higher-risk transactions. Calibrating transaction monitoring scenarios to flag unusual behaviors specific to these profiles is critical. Geographic risk. The location of the institution's operations, as well as the geographies in which it conducts business, plays a significant role in risk assessment. Institutions operating in high-risk jurisdictions, either those with weak AML regulations or those identified by bodies like the FATF as non-compliant, must fine-tune their transaction monitoring scenarios to detect potentially suspicious activities, such as cross-border transactions involving these regions. Product and service risks. Different products and services carry different risks. For example, high-risk products such as private banking, cross-border wire transfers, or trade finance require more stringent monitoring. In contrast, low-risk products like basic savings accounts may not need as intensive scrutiny. Tailoring scenarios to capture these variances ensures that resources are allocated efficiently, focusing on higher-risk areas. Transactional behavior. Analyzing historical transaction data helps to understand normal behavior patterns across different customer segments, which can then be used to define thresholds for monitoring. For example, what constitutes normal behavior for a corporate client will be vastly different from that of an individual retail customer. Calibrating monitoring systems to recognize these distinctions is crucial for identifying truly anomalous activities that warrant further investigation. By thoroughly evaluating these key risk factors, institutions can develop transaction monitoring scenarios that are fine-tuned to capture suspicious behavior unique to their operational environment. This tailored approach ensures the system is not only effective in detecting money laundering but also efficient in minimizing false positives. Three, review historical data and patterns. Use historical data to understand typical transaction patterns and behaviors, which will inform the initial thresholds for your monitoring scenarios. This involves analyzing both legitimate transactions and previously flagged suspicious activity to establish patterns for average transaction size by customer type and geography, frequency of transactions and deviations from normal behavior, peer group analysis. Compare the behavior of a customer against similar customers. By studying these patterns, you can set appropriate parameters and thresholds that will filter out normal business activity while identifying potentially suspicious behavior. Four, scenario development and optimization. Scenarios are predefined rules or algorithms that help detect patterns of suspicious behavior. Developing appropriate scenarios requires translating money laundering typologies into monitoring rules that fit your institution's risk profile. Types of scenarios to monitor. Common transaction monitoring scenarios include large or unusual transactions, identifying unusually large deposits, withdrawals, or transfers, especially those that deviate from the customer's historical activity. Structuring, detecting attempts to break up large transactions into smaller ones to evade reporting requirements. Frequent international transfers, monitoring customers who send frequent transfers to high-risk jurisdictions. Cash-intensive businesses, identifying businesses with high cash volumes that do not match the typical patterns for their industry. Threshold setting. Setting thresholds is one of the most critical aspects of scenario calibration. A threshold that is too high may result in missed suspicious activity, false negatives, while one that is too low may generate too many alerts, false positives. Thresholds can be adjusted based on customer profiles. Adjust thresholds based on the risk level of the customer. High-risk customers may trigger alerts at lower thresholds than low-risk customers. Geography. Cross-border transactions with certain high-risk jurisdictions should have lower thresholds. Historical data. Use historical transaction data to set realistic thresholds that capture suspicious behavior while minimizing false positives. 5. Validate with backtesting and tuning. Once the scenarios are in place, it's essential to validate them through backtesting. This involves running historical transaction data through the monitoring system to assess the effectiveness of the scenarios and thresholds in detecting suspicious activity. Steps for backtesting. Select historical data. Choose a representative sample of historical transaction data for backtesting. The sample should include known suspicious and non-suspicious transactions. Run data through the system. Simulate how the system would perform if the scenarios were applied to the historical data. Analyze outcomes. Compare the results with past suspicious activity reports, SARs, and known patterns of behavior. Identify whether the system flagged the right number of alerts and assess the rate of false positives and false negatives. Scenario tuning. Based on the results of backtesting, you may need to tune the parameters of the scenarios. Adjust thresholds or the specific conditions in the scenarios to improve their effectiveness. This tuning process may need to be repeated several times to ensure an optimal balance. 6. Monitor and adjust for emerging risks. Money laundering typologies are continuously evolving. New risks and techniques emerge as criminals adapt to regulatory and technological changes. Continuous monitoring and adjustment of scenarios are necessary to ensure they remain effective against emerging threats. Ongoing monitoring. Regularly review the effectiveness of your transaction monitoring scenarios by tracking false positive and false negative rates. High false positives indicate the need for more precise scenario tuning, while high false negatives suggest that you are missing suspicious activity. Analyzing regulatory and law enforcement alerts. Incorporate guidance from regulators and law enforcement on new money laundering schemes and typologies. Benchmarking against industry standards. Compare your institution's AML monitoring system with industry best practices to ensure alignment with evolving standards. Incorporate new data sources. As new data becomes available, integrate it into the monitoring system. This may include new customer data points, changes in risk ratings, or the integration of external data feeds, such as sanctions lists, PEP databases, or adverse media reports. 7. Use of machine learning and advanced analytics. As technology advances, machine learning, ML, and advanced analytics are playing an increasingly important role in transaction monitoring. ML models can analyze large volumes of data and detect complex patterns that rule-based systems may miss. Consider integrating machine learning algorithms to identify hidden patterns. ML models can detect unusual behaviors that deviate from the norm, even in cases where traditional rules might not raise red flags. Automate scenario tuning. Machine learning systems can automatically adjust thresholds based on changing transaction patterns, improving system accuracy over time. 8. Training and stakeholder involvement. The success of transaction monitoring calibration also depends on training the relevant stakeholders and ensuring they understand the importance of proper calibration. Training for analysts. Ensure that AML analysts and compliance officers are trained to recognize new money laundering trends and risks, interpret alerts generated by the monitoring system correctly, provide feedback on the effectiveness of scenarios to fine-tune calibration efforts. Cross-department collaboration. Effective calibration also involves collaboration across various departments, including risk and compliance, for scenario development and regulatory alignment, data and technology, to ensure the availability of relevant data and technical integration, business lines, to understand normal customer behavior and business practices. 9. Documentation and audit trail. Finally, it's essential to document the calibration process thoroughly. Regulators will expect detailed records of the rationale for thresholds and parameters, scenario changes and the reasons for those changes, backtesting and validation results, continuous tuning efforts. Clear documentation not only demonstrates compliance but also allows for an effective audit trail in case of regulatory inquiries or internal audits. Conclusion. Calibrating AML transaction monitoring scenarios is a critical process that ensures the effectiveness of an institution's efforts to detect and prevent money laundering. It requires a risk-based approach, continual refinement through backtesting and tuning, and adaptability to emerging risks, with a right balance between scenario sensitivity and specificity. And by leveraging advanced technologies like machine learning, organizations can optimize their transaction monitoring systems to stay ahead of evolving money laundering threats while minimizing unnecessary alerts. Keep learning. At Learning tab,